Welcome to Financial Issues, where we join reality with truth, helping you make the most of your money by honoring God with your investments. Now listen in as we give you the practical tools and advice you need to become a biblically responsible investor.
Welcome to Financial Issues. We're so glad that you tuned in today. We've got a lot to talk about today. Financial Issues, first of all, let me tell you, is a ministry that helps to educate God's people about financial issues from a biblical worldview. So we talk about things like stewardship. We talk about things particular to our mission, which is defunding darkness. We give you a biblically responsible investment strategy so that you can honor Christ in the way that you invest by screening out companies who are using shareholder dollars to fund ungodly agendas. We also encourage you to be diligent in your stewardship by funding the light, to be a joyful, generous, and obedient giver. Well, today we're going to talk about inflation. That seems to be the topic on everybody's mind for the past several years. So we're going to beat that dead horse, I guess, a little bit more. No, really. We're going to give you some useful things to think about as it relates to inflation. And we're going to have our friend Jason MacDowell on later in the show to discuss how inflation is impacting Social Security. So you're going to want to stay tuned for that. Our stewardship verse today comes from Proverbs 12:25. Anxiety in a man's heart weighs him down, but a good word makes him glad. You know, there's a lot to be anxious about if you look at the news. There's wars, there's rumors of wars, there's natural disasters going on everywhere. There's horrific human trafficking events, addiction stories, terrorist stories. There's, it doesn't take long at all to get anxious if you just turn on the mainstream media in the evening. But you know what? I'm so glad that we have a good word that can make us glad. And I hope that we are not neglecting to spend time in that good word every day. Seth, what do you think?
Yeah, you're right on, Shana. It is, in fact, the good word. It's the inspired word of God that makes us glad. And, this verse tells us the Lord doesn't desire that we'd be anxious. We need to trust in this ultimate good news, the Word made flesh, Jesus Christ. That's what this good word, the Word of God, points to, is the Word. So I would hope that we would, as we're tempted to feel anxious, that we would look towards our Lord Jesus Christ for hope and help. It's good stuff. Well, Shana, let's move to our topic today. We got a good question from a partner on inflation. So Larry is asking, Shana, what stocks are best if inflation is really bad? And I guess just as a kind of a follow-up to that, what are some of the best ways to invest that offer protection against inflation, Shana?
Yeah. Well, of course, our partner strategy is sort of our secret sauce here. So to find out the exact stocks that we like, you'll have to become a partner and take a look at the buy list, because things that we think inflation is going to be a problem going forward. So we formulate a lot of our picks with that in mind and how to stay ahead of inflation. So to be specific, to answer the question specifically, you have to be a partner to check out our buy list. But to answer in general, the stocks that are the asset classes that have traditionally thrived during times of high inflation are gold. Although gold is not something that is on our actual buy list at the time, there are stocks that are related to that kind of capitalize on that trend. Real estate, so you'll find we have real estate investment trust that are on our buy list right now. We have other companies that are home builders and are deal with the land that you need to have to build homes on. And then commodities. So think food and energy. We have food companies on our list that we think are going to do a good job keeping up with inflation and staying ahead. And of course, energy companies as well. And, there's other trends that support some of our picks as well. But inflation is certainly a theme that we talk about every single week. So, to stay ahead of inflation, you have to invest in assets that make more than inflation. It's just that simple. Stocks, if you look at a very, very long-term historical average, stocks have averaged 9% over a long period of time. Bonds, on the other hand, or fixed income investments, have averaged 5% over the long run. Not so much, not really close to that 5% number in the last couple of decades until just recently. But, for the most part, nobody is 100% equities and nobody is 100% bonds. Most people are somewhere in the middle because we believe in diversification. So let's say that you adopt the strategy. It's not necessarily our strategy, but let's just say that you adopt the strategy of a 60-40 portfolio, 60% in equities, 40% in fixed income. Well, if you use those two long-term numbers to get a weighted average, then your expectation for a balanced portfolio would be a return somewhere in the neighborhood of an average of 7.4%. So what has inflation done? Over the last 20 years, inflation has averaged 2.5%. Now, over the last 5 years, inflation has averaged 4%. Are we going back to the Fed's target of 2%? I don't think so. The Fed seems to think that they're confident that they've conquered inflation. But, if you look at the things that are happening really in the economy, our government who can't manage their lunch money, who can't balance a budget. I think the most recent number for the budget this year, $1.8 trillion deficit. That's not a slight miss. That's a bad miss. In corporate America, you would be fired. In fact, you'd probably be banned from the industry. So over the last 5 years, inflation's averaged 4%. So if you're looking at a real rate of return, because that's what we live in, is reality. We can, crunch numbers and look at numbers all day, and the government would have us distracted with those numbers so that we could be convinced that Bidenomics works. But, the real rate of return, even if you just are crunching the numbers from that perspective, if you've had inflation at 4% and you've gotten that weighted average, you've had a 60-40 portfolio, and you've had a weighted average of 7.4%, your real rate of return in the last 5 years has declined from 5% to 3.5%. So that's not all that happens. For people who make it into retirement, who are using their portfolios to supplement their retirement income, let's assume now that you're taking a 4% drawdown. So if you're in that latter case, if you're, inflation's taking 4%, you're taking another 4%, you now have to get an 8% rate of return in order to keep ahead of inflation. So what do you have to do? You either have to draw down your principal, and hopefully you have enough, to keep you going through the rest of your life, or you have to try to get a higher rate of return, and that involves taking more risk. So it's a tough situation that retirees are put in these days.
Yeah, good, Shana. That's really helpful there. How about this? Is there any hope that inflation might die down in the near future, or is it time for us to just accept that it's a normal part of financial life, and just like you say, taxes are always going to be there, and they'll probably be higher in the future than they are right now? Do we just assume that inflation is going to keep on building and building?
Well, if you listen to the Fed, you might be hopeful and think that we're going to reach that 2% target again soon, but I'm not there. Not unless Congress, and not unless we, the people, get a hold of Congress and convince them that they can no longer spend money that they don't have, that they have to figure out how to balance a budget. They have to do some hard things, and, they're going to have to start being fiscally responsible. But, neither Trump nor Kamala are fiscal conservatives. I mean, if you listen to the campaign rhetoric right now, they're just trying to one-up each other as to how much money they can actually give away. No taxes on tips, no taxes on Social Security, giving these tax credits for this, giving away this. We're going to build, 3 million homes. We're going to, do all these things. That sounds really expensive to me. The only person that I've heard, talking about reducing is when Trump said that he would like to give Elon Musk the job of cutting out some of the fat in the government, and I hope he wins. And personally, this is me personally speaking, not the ministry, but I hope that we see the policies of a Trump administration actually come into fruition. But I would add to that, and I would say, hire Elon, bring Elon in, let him bring the kitchen sink just like he did on his first day of Twitter, and figure out how to turn this ship around.
Definitely. And then just the last question here, Shana, how does our strategy offer partners the opportunity for protection against inflation?
Well, it's like I said, we in the first part of the question is what we look at the assets that we know traditionally have done well during times of high inflation, and we're incorporating that into our strategy. We look at other long-term trends. We think that agree with it or not, AI is a trend that's going to unfold. And so, we're looking in and around companies, not just the NVIDIAs of the world. There's more to AI than just NVIDIA. So, if you look through our list and you start to read the descriptions of the companies, you're going to really see, if you know what AI is and what it's going to take, all the energy that it's going to take to get there, then you'll kind of get an idea of where we're going. So, we try to create asset allocation models that are going to try to stay ahead of your distributions, your taxes, and your inflation. And that's why, we don't have a 60-40 portfolio. I wish we could minimize risk in that way, but, the way that things are, we just, the real risk, I think, is inflation. All right, folks. Well, we're going to take a break here, but don't go anywhere. We're going to be back with more financial issues right after this.
One of the emphases of preborn has been ultrasound in two ways. An ultrasound machine if a pregnancy clinic doesn't have one, and then an ultrasound session, which we underwrite hundreds of thousands of those. We've seen over and over again the dramatic results that when a woman encounters her baby for the first time and hears that heartbeat, she realizes the magnitude of what's happening here, that there is somebody else, that's her baby. So this is why preborn pushes out ultrasound as much as we possibly can. Preborn has seen over 200,000 babies saved, over 59,000 people come to Christ, populating earth and eternity, life for this life and life forever. Save the baby's life, but save the mother's life so that she can lead that baby to Christ. If we're bringing people into this world and the mother doesn't receive Christ and the child is born and the child lives its life and doesn't receive Christ, this is not a good end. And so we have to have the gospel as part and parcel and really the heartbeat of what preborn is.
There are moments in life that define us. Choices determine the courses we take. Choices that create life, or those that save a life. And some make life worthwhile. There are decisions to stay, or to go, to remain the same, or to grow. Sometimes we pray and make peace. Other times we take a stand for what we believe. In celebration, mourning, triumph, and defeat, we are invested in every decision we seek. Despite differences, we have one thing in common, the desire to do all for the glory of God. Keep your wallet aligned with your heart and your investments in harmony with your faith. Timothy Plan, biblically responsible mutual funds, ETFs, and retirement plans. Before investing, carefully consider a fund's investment objective, risks, charges, and expenses contained in the prospectus available at timothyplan.com. Read carefully before investing.
Welcome back to Financial Issues. Thanks for hanging with us. I think we got some more questions that we want to get to, right?
Sure do, Shana. Yeah, let's start with Cynthia. Actually, kind of a nice follow-up to our conversation in that last segment, Shana. Cynthia's saying, I am in the process of changing to the income asset allocation, and I will be soon retiring and will be relying on the income to supplement my Social Security. Having sold several positions earlier this year due to sell alerts, I'm underweighted in several sectors. There are not many buys which pay dividends, and I remember Dan saying if you're an income investor, don't own positions that don't pay dividends. What advice would you have for Cynthia, who is 63 years old, by the way?
Yeah, Cynthia. So at age 63, now keep in mind that our asset allocation models are based around the notion that you would retire at age 65. 63 is somewhat close. I would ask you to consider not starting the income portfolio yet. So you'll see kind of the age attached to our income portfolio is 75 and up. And, this really is Seth, you're right. It's a great follow-up to the conversation that we just had about inflation. So we've had inflation higher, averaging 4% for the last 5 years. Supposedly inflation is lower than that right now, but I think inflation is going to continue to be a problem. So, what you have to have at age 63, I don't know exactly what your life expectancy is, but I would suspect that it's probably at least somewhere around another 30 years. So if you're going to be drawing down on your portfolio for 30 years, and you're going to have inflation happening, let's just assume that it keeps happening at 4%, prices are going are going to double in short order. In another 10 to 15 years, prices are going to double. So what does that mean for your portfolio? Well, for your portfolio to keep up and not be able to draw down into the principal, it means that your portfolio has to double as well. So, I would suggest considering the 65 portfolio that is growth and income oriented. So the reason that Dan used to say that if you're an income investor, all you care about is the income, well, that's because the income portfolio is designed to throw off a higher income than just a growth and income portfolio. But if you've got 30 years left, you have to have some growth. So, I would just encourage you to consider that growth and income 65 portfolio for now. And there are a good bit of companies that are on our buy list right now that do pay good income.
Awesome. Next one, Shana. John is asking about HC63, wondering, can you explain the process of the buyout of this company and the steps I need to take with Fidelity? That's my custodial account. All I have been given from Fidelity is documents pertaining to the citizens of Israel for tax purposes, and I am not an Israeli citizen. How do I sell these shares that have a QSIP number attached to those shares? John is also 63.
Okay, so this is a company, we issued a sell alert for it a while back because it was being taken private. It was being acquired by a private company. So the assumption, the working assumption is just that private company would pay out the value of those shares. We did issue a sell alert on it, though, so it took me a little bit of time to find what happened if you didn't follow the sell alert. So what happens is that you'll have to contact your broker-dealer. There is a link that either you or they have to go through to get the redemption for the shares. The tender offer, I believe, was about $43 a share. So just multiply that by however many shares that you had before the acquisition happened. And we'll have Pat send you the link, and you may be able to go to that link and take care of it yourself, or you may have to recruit the assistance of the custodian that holds your account. But we'll have Pat send over that link to you.
Awesome, Shana. That sounds good. Deborah's up next. Not a partner. Interesting question here. She says, I'm going through probate with siblings. Now, probate requires that after my parents' home sells, to put all the equity into a money management account for the next 8 months until probate closes. We found out that we can legally go another route and submit to the judge that we'd rather put money into T-bills, tips, or precious metals. Banks look like they're going down soon with our current American dollar. We can't do crypto. What, in your opinion, is the best place to park $2 million of a family estate funds before distribution that gives us the best money devalue protection that is possible? We realize there's no perfect plan, not knowing the future. What do you have for Deborah here?
Well, my caution against having it all in one bank account is, of course, it would likely exceed the FDIC limits at $2 million. So, 8 months may seem like a long time, but it's really not. And I think that the primary goal for preserving that money until probate closes is probably just to have it in a money market. Money markets are still paying, as far as I can tell, somewhere between 4 and 5%, closer to the 5% range. I do expect that rate to drop, but precious metals are speculative. They can go up and they can go down. So what if you get a big bill and the estate has to pay out that bill within 30 days and you don't have the luxury of waiting for the precious metals to rebound. So I don't think it's a good idea at all to go into anything that can fluctuate in value. And I think 8 months is going to go by a lot quicker than you think. So I would just look at keeping it in a money market that's getting a good yield.
Awesome, Shana. Good stuff. Marilyn's up next. 70 years old. Says, requiring the minimum distribution requirement use of an IRA fund regarding the minimum distribution requirement use of an IRA fund to qualify donations to avoid paying taxes on the donated money. I understand this can be delayed now to age 72 and a half, but can it be started at 70 and a half? How's the age calculated? For example, with a birth date of April 27th, 1954, would October 27th, 2024 be the effective start date for 70 and a half? And then a similar one for 72 and a half as well. We got a similar question on Friday from one of our callers, Shana. What do you think?
Okay. So the distinction that you need to make here is that there are two different sets of rules. So qualified charitable distributions are made possible by one set of laws, and that set of laws still says age 70 and a half. RMDs used to be required at age 70 and a half as well, but that has changed. In fact, going up, the age is gradually going up to age 75, depending on what year you're born, which is the perfectly reasonable explanation about why Maryland's confused here. So it depends on exactly when your birth date is. Now, on your brokerage account, or if you just Google it and use a reputable RMD calculator, you can punch in your birthday, you can punch in the birthday of your beneficiary, and it's going to tell you exactly when you need to take what age you will need to take distributions. Now, the amount of the distribution is going to be unknown at this point in time because it's going to be calculated off your year-end account value in the year before you're required to take the minimum distribution. So if I use a calculator right now for October the 27th of 2024, it looks like you would have to take your first required minimum distribution. That's something different than a QCD. You would have to take your required minimum distribution before the end of 2027. Now, that gives you, a different deadline. Whenever you're looking at the QCD, it's truly age 70 and a half. So if your birth date is in April of 1954, then you would have to wait until after your birth date plus 6 months in the year 2024. So it would be that toward the end of October date that you give there. So good question.
Yep, good stuff. Mark and Lisa up next. Mark is 63, Shana, and says, do we have to withdraw the money from a non-qualified investment account within 10 years or at the time the original owner was required to take RMDs? Basically, what are the requirements, if any?
None. That's a great rapid fire Friday question. So, when we're doing estate planning, we always want to look at the types of assets that you have, because there are great assets for people to inherit, and there are any asset is desirable to inherit. I'll just say that. But there are some that are more desirable than others to inherit. The one that is desirable to inherit is the one that you describe here in a non-qualified investment account, unless, of course, it's an annuity, because annuities have kind of the same tax rules as IRAs do. You are potentially going to have to pay some capital gains tax on the increase of that there. So in a non-qualified investment account, the cool thing about that, at least for the time being, is that you get a step up in cost basis on those assets. So I was recently talking to some people who, the lady is in her 90s. She's got some considerable gains in her portfolio, and her kids are going to be the heirs to that. So, the neat thing about the step up in cost basis is that when those assets pass to the children, they inherit the money and the assets, but they don't inherit their parents' cost basis. So the cost basis steps up to whatever the current value is on the day that it passes. So they get a new cost basis. Theoretically, if they were to sell all of the assets, it probably, logistically speaking, it probably cannot happen in this way. Because you have to wait on a death certificate to get the paperwork process rolling. But as soon as you get those new accounts open and the assets transfer into those accounts, you're able to sell them. And when they transfer into the accounts, most brokerages will actually carry over the new cost basis for you. It will show you. So, if you own 100 shares of stock at $10 a share, and the cost basis was, say, $5, when the heirs inherit it, they get the cost basis of $10, whatever it is, on the day that the current owner passes.
Awesome, Shana. Probably last one for today is Jim. He's in the 55 to 65 model. Purchased a couple CDs using a 2-year ladder. He got a notification from Fidelity that 2 of the CDs were called. Using the portfolio tracker, they're at 21% cash right now, 14% in fixed income. Should they increase fixed income a little or stay in cash for now? And he's 62.
So that's a total of 35%. I probably would opt to stay in cash. We did put out some guidance. We did put out a note on Wednesday of this week. I don't know if this question came in before or after that. But, Jim, I would suggest reading that. It's on the partner commentary page. At the very bottom, we give some tips for the strategy. And considering your allocation, I may just consider staying in cash unless you can find a CD that's paying over 4.5%. I would opt for the cash that's paying around 5%. The other thing that you could do is if you're light in preferreds, you could look at some of those to replace some of those CD that's coming due. But take a look at that note on the commentary. Well, folks, if you're listening on an outlet that only carries a short version of the show, we have to wish you a farewell. But we hope that you have a way to stay tuned, like our phone app, because we're going to have our friend Jason MacDowell coming up to talk about what the cost of living adjustments are on Social Security and how that impacts. Is inflation, national debt, and volatility in the markets causing you anxiety? Well, you're not alone. I'm Shana Burt, host of Financial Issues, a nationally syndicated, biblically based program. During our daily program, we help you navigate the current financial climate and provide valuable insight so that you can be a good steward with the money that God has blessed you with. The Bible tells us not to worry and to seek wise counsel, and that's why Financial Issues is here.
Join our partnership community by visiting financialissues.org/join.
Hi, this is Shana Burt, the host of Financial Issues. The Financial Issues family is so blessed to have saved tens of thousands of babies, all thanks to the generous support of you, our listeners and viewers. For $140, you can sponsor 5 ultrasounds. Please go to preborn.org, that's preborn.org, or financialissues.org and click on the Preborn logo. Save a baby, save a life.
Fear and uncertainty can cause us to hold things tightly and rely on ourselves. But during uncertain times, as believers in Christ, we are called to surrender fully to our sovereign God. The call to surrender to Jesus is one step in our growth in holiness. And it doesn't just mean you give over a few things. It means He gets it all, including our finances, our investments. Learn a biblically responsible investment strategy proven over 25 years. Keep the money God has entrusted to you out of companies that participate in things that God detests. Fully surrender. Become a Financial Issues partner today. Learn more by going to financialissues.org/join. That's financialissues.org/join.
Initially, when we became members, I thought, what if this doesn't work? I mean, we're going to give up this whole concept of insurance, and we're going to trust God and His people. And I was like, yeah, well, of course. I'm going to trust an insurance company to come through for me, or I'm going to trust the church to come through for me. And that's a no-brainer. I love getting the monthly share that I give to each month that has the name of a real person and their real medical concerns and a prayer request, for them. If I have a need, I know I can go get care. I can see the providers I want to see. I don't have to worry if they're in my network. And if we need medical care, the Samaritan is there.
A community of Christians paying one another's medical bills. For more information, go to financialissues.org and click the Samaritan Ministries banner.
Securities offered through G.A. Reppel & Company, a registered broker-dealer and investment advisor, member FINRA and SIPC. Opinions expressed by Shana are hers alone and are for informational purposes only and do not necessarily represent those of G.A. Reppel or the outlet on which you are listening. You should consider how the information applies to your situation prior to personally implementing it and consult any financial professional you work with to make sure it's applicable to your financial plan.
Welcome back to Financial Issues. Thanks for sticking with us. We've got our friend, my colleague, Jason MacDowell back to talk to us again today. And, we've been talking about inflation. Inflation has been top of the mind and a primary topic of every economic news source, including this one for the last few years. We just got the CPI and PPI numbers out last week. CPI came in hotter than expected at 2.4% for the headline number, 3.3% for the core number. Medical care, we learned medical costs are up 3.3% year over year. Health insurance prices up 7.5%. Owners equivalent rent up 5.2%. Rent of primary residence up 4.8%. Motor vehicle insurance, car insurance up over 16% year over year. Now, the real number that matters, at least to the Fed anyway, is the PCE number. That the new one doesn't come out until October the 31st, but the current number sits at 2.2%. Official statistics show that the dollar's value has declined by 20% over the last few years. But industry data, like the ones I just mentioned, grocery, rent, housing, insurance costs, suggest that actual inflation relevant to the particular individual consumer is somewhere between 34 and 60%. Now, this is partly true because the official numbers don't accurately reflect what is happening in reality. It's just impossible to create an index that accurately reflects changes for the trillions of factors influencing inflation, and partly because the group of people that are putting out these government numbers are part of are unelected bureaucrats. They're part of a Biden administration that has a vested interest in making that administration look good. The bottom line is that the cost of living has not gone up at least 20%, that it has gone up at least 20%, probably more, and it has not stopped its upward ascent. So we hear that inflation is under control, but it has not stopped going up and is definitely not going down. So, Jason, it seems that we've been stuck on this topic of Social Security for quite a while, but it's a topic that impacts many of our listeners and many partners. So could you talk for just a minute how Social Security deals with this topic of rising prices in relation to cost of living adjustments, or COLA?
Absolutely. So that cost of living adjustments is determined the third quarter of each year for the next year. So on October 10th, there was some predictions before October 10th on what COLA was going to be for Social Security. Then it was announced on October 10th. But the method that Social Security uses is it just reviews the percentage changes in the Consumer Price Index, W, which is really what it's a subset of the CPI, which covers urban wage earners and clerical workers. And that data is what they use to determine. So the prediction was about 2.5%, and that's what it's going to be for 2025. So basically, those that are on Social Security right now will have a additional 2.5% added to their benefits for 2025.
Yeah, 2.5.
Yeah.
But Social Security recipients are not super excited about 2.5% increase, especially with all of the stats that I just mentioned about everything else going up so much. So how has Social Security increased benefits in recent history? And well, you already told us what's on tap for 2025, but I remember some excitement a few years back when they got a 9% increase.
Yeah, very close. So historically, it just rides with inflation. It's supposed to keep with inflation, but we know that everyday prices that we go and buy from the grocery store doesn't really reflect that. But when we use the numbers, the Jimmy Carter years, I think, are good years where the numbers were double digits. So the inflation was really high. It was the late 70s. So there was 3 years there where it was really high. So it hasn't really been as high as what 2023 was. 2023 came in at 8.7%. And that is actually more than a delayed credit in one full year. So delayed credit, again, is, if you wait till full retirement age and then 1 year after that, from that period of time, you'll have a delayed credit of 8% added to your benefits. Those are delayed credits. And then, of course, you get subsequent ones until age 70. So COLA came in at 23 at 8.7%. The next one before that, 22, 5.9%. And then, of course, historically, it kind of fits around the 1% to 2% area. Sometimes you can look at it as an average of 2, but it sits between those. So that's where it kind of sees high. So now we've kind of come down. It rides with the CPI, so it's ridden down a little bit from that point. So in 2025, we'll have 2.5%. For 24, everyone had a 3.2% increase. So we saw it go up in 23, and now it's kind of riding down pretty quickly.
All right. So I'm fixing to make you look like a rocket scientist, but no, really, we did a little bit of this math ahead of time. So yeah. Jason, tell everybody what was the average monthly benefit for someone starting Social Security back in 2020?
So the average back in 2020 was, if you were claiming at your full retirement age, and since everybody's birthdays are different, it'd be the age 66 to 67, roughly in 2020. That average benefit was about $1,500.
Okay. And so what would it be today? What was that in 2020, or what would it be today?
So today for 2024, the average benefit, if claiming at the full retirement ages of 66 or 67, is going to be $2,000. So that's kind of the numbers we used for some examples.
So that's say a 75% increase if you hadn't started claiming yet. But let's say that you had. Let's say that you started claiming back in 2020, and the average benefit was, did you say 2,000?
Yeah, I'll use for our numbers 2,000. So let's just say monthly benefits were 2,000 back in 2020. Well, COLA for that year was 1.6. So.
Okay. And then today, that benefit is what? Around?
Roughly shy of 2,450. It's just shy. About 2,444 would be what today's is from that difference. Mm-hmm.
Okay. So even though it kind of looks like that's roughly like a little over a 20% increase. And we're told inflation is up 20% since 2020. So it looks as though Social Security has kept up with cost of living just on the surface if we're using the government numbers. But the reality is that retirees' income has not kept up. We're seeing that in our practice. We're seeing retirees have to draw down more off of the money that they've saved. You know, most pensions, most people are not just living off of Social Security. And if they are, you know, it's a really tight budget for them, and it looks more and more impossible just to live off Social Security going forward, because most pensions don't get cost of living adjustments. You know, so this leaves the retirees to need to draw down more and more off of their portfolio. You know, if they have an overly conservative approach to investing, not only have they missed out on return during this time, but they have likely hindered their ability to stay ahead of inflation, because that's a risk that is just as real as market loss. So market loss and loss of purchasing power that's caused by inflation can be equally detrimental to the income of retirees. Do you have anything that you wanted to add to that?
Just that it's very important to have a strategy. So you can't beat the delayed credits. Adding to your monthly benefits to maximize your Social Security. And then you have to have assets on the side. I know there's a lot of people that live just basically on, Social Security at that point. They're very limited on what they can have at that point. So it begs the need to have a larger strategy of retirement savings. And then we also have to factor in taxes. Another reason why Social Security, we can't use these numbers correctly, even though they're adding COLA to it, is because the government also taxes it, So a portion of that gets taken out. And then on top of it, a simple answer is that corporations, when you buy your groceries, you're buying at a profit. You have to, because the vendors that are in those grocers have to make a profit and be profitable on top of the inflation that they're passing on to the consumer. So that's where all these numbers just it doesn't help with the COLA. So it's very important to have a good strategy for claiming, but also having a larger strategy with supplementing with your assets and your retirement savings. So
yeah, good stuff. And this conversation may totally change after the election, right? Because I think both Kamala and Trump, I don't know, I can't keep up with the rapidly changing minds here, but I think both of them want to eliminate taxation on Social Security, which I think would help. Lots of people don't pay taxes already on Social Security, but it would certainly help those people that do pay taxes on Social Security. Mm-hmm. Well, thanks for joining us today, Jason. It's always a great conversation when you come on, and I really appreciate your feedback. Well, folks, we hope that you're going to stay tuned with us because we do have more financial issues to come after this. If you're just tuning in or maybe missed the first part of the show, you can always go back and catch the whole show. We're on Apple and Spotify podcasts. We're also on social media, YouTube, Rumble, Facebook, Instagram, X, all of those things. Make sure that you like and follow us there. That helps to boost those algorithms. And if you do Rumble, make sure that you follow us on there because I believe that we're monetized, so we get a little bit of money back from that. Well, stay tuned, folks. We got more financial issues to come. Are you a Christian seeking to align your investments with your faith? I'm Shana Burt, host of the program Financial Issues. During our program, we share valuable information about the financial issues of the day, including how markets and the economy are moving and how public companies are behaving, helping you to make wise decisions with your investments and the money that the Lord has blessed you with. Using biblical standards, we provide you with valuable financial insight based upon Scripture, making it easy for you to invest in a way that aligns with your values. I can assume that most of you have investments in a 401k or IRA, but what I am sure of is most of you have no clue that the companies in your mutual funds may be funding the LGBTQ agenda, pornography, abortion, the list goes on and on. By listening to Financial Issues, you will learn how to get rid of those investments that are dishonoring God.
Become a partner today by simply going to financialissues.org/join. Click the green button to become a partner today. How is Timothy Plan continuing to lead the fight as you guys now enter your fourth decade of leading this fight of biblically responsible investing?
We've been too silent for too long, and we can no longer be silent. You stand up, like Ronald Reagan said, we're only one generation away from losing all of our liberty. Yeah. It has to be fought for. I wish it didn't. And you can fight for it. You don't need guns and ammunition and that. You can fight for it, especially with your dollars, because it's always about the money. And when the money starts impacting people, they start paying attention. When we launched this, they said it couldn't be done, but here we are 30 years later. They said you couldn't get competitive returns, but here we are.
What a tremendous testament of God's grace.
Go to financialissues.org/Timothy Plans to learn more about Timothy Plan.
The opinions and recommendations expressed on this program do not necessarily represent the opinions of the station or any of the program sponsors. Additionally, all products or services offered by the program sponsors may not be known by the program.
Welcome back, folks. Hope you enjoyed that conversation with Shana and Jason. It's always fun to have Jason on. By the way, Jason he does live down in the southeastern part of the country. He was safe during those hurricanes, so we're grateful to hear that for Jason, that he's doing well. Great to have you all here on this Monday. Happy Columbus Day, by the way, to all of you. It is Columbus Day. In fact, I'm not calling it the other name that people have made up for this holiday. It is Columbus Day. Columbus was a great man, certainly a controversial figure to be sure, but a great man nonetheless. If you want to learn more about really one of the most important figures in all of history, I believe, you got to check out our Moment in History episode that we have on him on FISM TV. If you go to FISM.TV under A Moment in History, there was a new episode that we did on kind of the hidden reason of why Columbus went on his voyage. So I think you'll find it quite fascinating. And I'll tell you what, for those of you who are watching on the chat, I'll give you a little gift here this Columbus Day. I'll go ahead and put that link in there. And I put the wrong thing in that link. Whoops. I put 1 Timothy chapter 3, verses 14 through 17. Let me try that again one more time. We'll get that this link here to the Columbus Day Sometimes technology is just the worst. Even for a millennial like me who's supposed to be really technologically proficient, sometimes I'm more inept. But there it is there. So the link is in the chat if you want to check that out today. Okay, folks, we've got the Ag Report coming up here. Craig Haugaard is back. His voice is feeling good. So let's hear what Craig has to say about, we're going to hang on 1 second, actually. The ag is not ready yet. We might not be able to get to it this segment, so we'll make sure to post that on the website. While we're at it, folks, let's get to the markets here. So on Friday, markets roared back positive after somewhat of a back and forth week. If you followed us last week, you noticed that the markets were just kind of going all over the place. Had a couple good days, couple really bad days mixed in there as well. But by midday, the indices pretty firmly in positive territory. It turned out to be a good week after all. The Dow Jones was leading the pack. Late afternoon, it was the same deal. By the closing bell on Friday, the Dow Jones was up around 1 percentage point. The S&P 500 about 2/3 of a percentage point. The NASDAQ about 1/3 of a percentage point. So the pre-markets, as they were sitting, were mixed, and they're still mixed as they've opened. They're awaiting some relatively important earnings reports that we'll get to in just a moment here. Before we do that, though, we will get to Craig Haugaard. We do have the ag ready now. So here is Craig Haugaard with today's ag update.
This is Craig Haugaard with your Financial Issues Ag Update for October 14th. Well, traders were hoping that Friday's monthly supply and demand report would offer some direction. But for corn, the report was fairly neutral. Now, the report did bump up the projected national average yield by 0.2 of a bushel over last month to a record 183.8 bushels per acre. That change added another 17 million bushels of production to this year's balance sheet. At the closing bell, December corn was 2 3/4 cents lower at 415 3/4. The USDA left both the soybeans planted and harvested acres unchanged from September at 87.1 million acres planted and 86.3 million acres harvested. Now, they did drop the projected yield by 1/10 of a bushel per acre down to 53.1 bushels per acre. At the closing bell, we saw beans trading lower, however. We had November down 9 1/4 at 10.05 1/2. Now, the USDA made several small changes to the U.S. wheat balance sheet, but overall, the global supply picture remains largely unchanged from last month. Here in the U.S., the stocks-to-use ratio is now 42.1%. That's the highest that we've seen since the 2019-2020 crop year. As a result, Minneapolis December wheat was 6.5 cents lower at 643 3/4. Kansas City dropped by 6.5 cents to close at 604 1/2, and Chicago was 4 3/4 lower at $5.99 per bushel. Cotton futures continue to be range-bound. At the closing bell, December was down 45 points at 72.21. Livestock futures were mixed. We had December live cattle 70 cents lower at $187.57 1/2 per hundredweight. November feeder cattle dropped by 15 cents as they ended the session at $249.80 per hundred. And December lean hog futures were 70 cents stronger, closing out today at $77.65 per hundredweight. Class 3 milk futures gave back the gains of the previous 3 sessions. At the closing bell, November futures were down 42 points at 21.03. Well, this has been Craig Haugaard with your Financial Issues Ag Update. We'll be right back with more financial issues after this.
Well, there's Craig Haugaard with today's Ag Update. Always good to hear from Craig. So this week in the economy, folks, we have a couple things happening here. We've got today, the bond markets are closed for Columbus Day. The regular indices markets are still open. The regular, equities markets. We're also going to hear Fed Governor Waller will speak later this afternoon. Tuesday, we get more Fed speak. Wednesday, we get import price index. Then Thursday, we get the jobless numbers as well as retail sales. And Friday, building permits. So somewhat of a quiet week here. A little more Fed speak, much like we saw last week. I think the big story in the economy this week is going to be earnings season. So earnings season kicked off technically last week. We saw JP Morgan Chase on Friday. We also saw Wells Fargo, some others report. This week is really kind of banking week. That's how the earnings cycle typically starts with some of the big banking and financial groups. So today, nothing much. Then Tuesday, tomorrow, we get Johnson & Johnson, Bank of America, Goldman Sachs, and Citigroup, as well as some others. That's really what I think the markets are kind of waiting for today to see what will happen with those. Wednesday, we get several smaller name financial banking institutions Thursday, Netflix is thrown in there, and then we also get Morgan Stanley and Blackstone, as well as some others. Friday, we'll get Procter & Gamble, American Express, and some others also. So that's what earnings season is looking like here, folks. Earnings season for quarter 3 of this calendar year. Keep in mind, we are in the middle now of quarter 4. Well, kind of more like the beginning middle, but still it's full swing for quarter 4 here. Interesting headline I saw over the weekend. Apparently, millions of Christians are not voting. Unfortunately, this is not a surprise, but this is the way that it is. As many as 104 million, it's calling it people of faith. This was a Christian Post article. This included 32 million self-identified Christians regularly attending church are unlikely to vote in this year's presidential election. Now, the caveat there, we always have to say that it's professing Christians, so we don't know if these are actual born-again Christians. We would know that by their fruit, of course, and by their love. But these are people who profess to be Christians. 32 million of them. I've seen that's actually somewhat of a low number. I've seen upwards of as many as 40 million self-identified professing believers in Jesus are not voting. That number is extrapolated from 2 surveys, actually. The most common reason apparently is lack of interest, and over half said they dislike the major candidates. Folks, I really do believe that we have to get over this. You know, you got to be a good and faithful steward of your vote. If you are voting for a sinner, which, newsflash, breaking news, okay, all of you are, then you can always find something to dislike about every single one. It really is a question of the lesser of 2 evils, I think, and understanding as well that you're not voting for a pastor. If this vote coming up was a vote for, the next elder slot in your church or the person to be your next pastor, neither of these candidates would qualify for a myriad of reasons. Neither one of them would qualify, but you're not voting for a pastor. You're voting for the person who's going to be the next president of the United States. And I believe as Christians, we have a responsibility to vote for the one that is going to align closest with the biblical worldview. I really believe that's our responsibility. If you're looking for a biblical ethic on voting, I think that's it. Later on in this week, actually, I'm excited. Shana's going to be joined by Deb Wuthnow. Deb is the president of iVoter Guide. She's coming on later this week to talk more about that. So we're looking forward to that. But folks, as we're nearing this election, if you're a Christian who is on the fence about whether or not you're going to vote, I would please urge you to consider voting as an act of stewardship and obedience to God. Also, if you're on the fence about which candidate to vote for, I would also encourage you to take that to the Lord as well, and to make sure that you are voting in line with the Word of God. All right, Grant, I think we have time for one question here. Grant, my brother, who is not actually my brother, folks, but he does look like it for sure. And that's a compliment for me because Grant's a very handsome guy. So
thank you,
there you
Seth.
go.
So are you.
I appreciate that, brother.
So we have a question from Joe. Are previous weekly commentaries archived for reference, or are they just replaced by current week's posting?
Joe, thanks for that question. It's a good one. Typically, no. This is part of why we want you to be vigilant about making sure that you absorb each week's partner commentary. The reason for this really is pretty similar as to why we don't keep all the partner conference calls up, is that the information is subject to change. So when we put partner commentary up there, it may be relevant for a week or two, and then something might change, and we have to change what we had said. Now, we're not changing our strategy. Keep that in mind, but we may change some different tactics that we go about, different offensive weapons that we go about, different things like that. We just want to avoid any possible confusion, Joe. So typically we'll just replace the commentary with whatever is most, like the most up-to-date commentary. With the conference calls, we're a little bit more lenient with it. We have a couple conference calls from the previous months, and then we also have Dan's timeless conference call that he did back on the Great Reset several years ago. But with the conference calls with the partner commentary, Joe, that's kind of how it works there. We do archive alerts, though. So that may be what you're looking for, Joe. If you're looking for, I'm wondering if I've missed anything. Do I need to go back and see? Go to the alerts page. We've archived those back, several years. I saw some alerts. I just went back and scrolled just for the sake of it. I went back and saw there were some from 2017, from 2018, and it's really thorough. So if there's any alerts, sells, any different kind of strategy updates, those will be on there. And that's helpful for you if you have missed a sell alert to always go back, or if you're wondering if you've missed a sell alert, just go back to that page there. It's under the partner side. If you just click on alerts, you can go. There's many, many different pages. I think there's probably 18 or 19 pages there as well. So it's the alerts page, partner side of the website. Scroll to the bottom, look through those pages. issues. My guess is that might help you out there, Joe. If not, follow up with a question there. We can see if we can help you out more. Great to be here with you today, folks, on this Columbus Day. I do hope that you will remember that everything you have belongs to the Lord, and so we must be found good and faithful stewards with it. God bless you all. Looking forward to being back again with you tomorrow. Until then, remember, it's all His. Let's be found good and faithful stewards. God bless you all. See you next time.
If we ever forget that we're one nation under God, then we will be a nation gone under.
Thank you for joining us. This has been an FISM production.